The interbank market is a conglomerate of various banks and large hedge funds that provide prices for currencies to various different brokers all around the world. Now, the prices provided to these brokers will vary depending on the relationship between themselves and the broker. So obviously, the better the relationship, the better or the cheaper the price is. Now, for the sake of this example, we're going to assume that the interbank market is always made up of the same players and that the prices provided to all different brokers around the world are exactly the same. So for the sake of the argument, let's say that the interbank market is quoting a price for the Euro USD currency pair at 1.4 thousand over 1.4 thousand. Now, for those of you who don't know, the difference between the buying price here on the left and the selling price here on the right is called the spread. Because there is a 1 pip difference between those two prices, we say that this currency pair has a 1 pip spread. So the interbank market is quoting and providing a 1 pip spread for the Euro USD currency pair to all different brokers around the world. Now, those different brokers will be the ECN broker, the market maker, and the STP broker. Now, the ECN broker will take this 1 pip spread derived from the interbank market and they will add another couple of pips on top of that to make a total of 3 pips. Now, the price that they're quoting is 1.3999 over 1.4002, so it's different to that of the original interbank market cost. The reason why is because they've added a 2 pip profit on there, so they've widened the pip spread you see in the middle here. And that's how they make money from you, so that's fair. The market maker will do exactly the same. So they will take this 1 pip spread, but they will undercut the ECN broker by adding only 1 pip up top of the original 1 pip spread. So the total here is 2 pips, so they will quote this price, which is different to the original interbank price, but it's also different to the ECN broker's price. And this is why the prices varied, or the prices were different in the two charts that we were looking at earlier. The STP broker has a mixture of both, so they will provide a 2 pip or a 3 pip spread to various customers depending on their success rate. So they kind of get the mixture of both worlds. Now, the ECN broker will provide true market conditions. So despite the fact that they're slightly more expensive, the actual market conditions supplied by the interbank market will be exactly the same trading or market conditions supplied by the ECN broker. And that's fair. So far, they're quoting you fairly and they're providing fair, true market conditions. Now, this is where the game changes. The market maker, despite the fact that they're cheaper, they will not provide true market conditions. In fact, they will manipulate market conditions in their favor. And they'll do this in a couple of ways. Number one, let's say that you place a buy trade with a profit of $400 at the profit target, and you get that trade and you hit your profit target and you generate $400. The market maker will also place the same trade into the interbank market, and they will also have a $400 profit. So when you get your winnings, they won't have to take any money out of their accounts to supply these winnings for you. Essentially, they will take the winnings from their interbank market account and transfer it into your account. And the only money they'll probably make is on the commission that they've charged you if they wish to do so. The second way is by using something called the virtual dealer plugin. Now, the virtual dealer plugin is a piece of software that allows brokers to trade against you either manually or automatically. Now, for example, let's say we're talking about the exact same trade where you hit buy and if you win, you will generate a $400 profit. Now, every time that you do this, or every time that you trade, you're putting your broker at risk. So it's within their interest for you to lose, because the risk can be so great if you're really successful. So they have to find a way to manage that risk. And the way that they manage this risk is by placing a trade opposite to you. So every time, what you'll see, for example, is your buy trade going up and up and up and up. And then finally, just before it's about to hit your target, you will see a big dump in the market and it will go against you and you will be stopped out. This is prime evidence that the Market Maker is using virtual dealer plugin software. For example, you may see a difference between the demo account and your live account. For instance, you are really successful in your demo account and you use exactly the same strategies in your live account, but all of a sudden you start making big losses in your live accounts and you see big spikes in the market in the opposite direction with no real economic data coming out. So this is just pure evidence that your market maker is trading against you either manually or automatically using the virtual dealer plugin software. Now, the reason why they can do this is because of this lack of regulation. You know, it is getting better every year and the regulation is getting tighter and tighter. So you must just do a bit more research when looking for a market maker broker, because they can trade against you. They haven't got your interest at heart. So I'm painting quite a bad picture of market makers here. That's not the point. There is a lot of market maker brokers out there who are great and they really do have your interest at heart. It's just that there are the odd few with offices in strange countries that whose regulations you're not even aware of that can trade against you. So just be slightly more careful. The STP broker, again, does a mixture of both, but it really depends how good you are in terms of which bracket you fit in. So if you're a bad trader, if you're not very successful, they'll probably make the market for you and provide you with a low pip spread, but put you in a manipulated market condition where they'll make you think that you're winning one day and then the other day they'll just trade against you. If you're a good trader, they might stick you in the true market conditions, but they'll widen the spread a bit more to ensure that they get as much profit from you as possible. In fact, they might even do the opposite depending on their business model. But whatever the case is, the STP broker, because they get the best of both worlds, they'll have various algorithms or people who manually look at trading accounts and see which bracket you fit into.